Happy Friday, everybody. I want to welcome you to today's webinar presentation, and we have three very special presenters here today. And the topic of today's presentation is really on the due diligence and the blueprint of creating a financial successful transition for dental practices. And I'm going to introduce the first speaker, who is going to be Joanne Tanner. Our first speaker I've known for many years. She's an MBA, but also, I always found interesting was she had been actually in the dental practice on the front lines and has been in this business for the better part of 4 decades. She's going to be sharing some information with you today on practice management and really clinical due diligence when you're buying a dental practice. Our second presenter today, let me go ahead and move that if I can. We have David Cohen. David is the owner of Cohen Law Firm, and his firm specializes in helping dentists with legal business transactions, their needs, including, this would be, anything from practice purchases, sales, partnerships, associateships, and really just business structuring and formation. David is one of the more recognized national speakers. He's extensively recognized in the dental community across the country. And I think he conducts, he had mentioned something around 275 practice transitions a year, which I don't know how you do that. So he's going to be a great addition. And then the last presenter that we have today is Brett Lemon. Brett is a principal at Thomas Dahl, where he specializes in minimizing taxes through strategy and planning. He does practice benchmarking, practice transitions, buyer representation, and even retirement planning for dentists. Brett is he has a master's degree in accounting, and I learned a little bit on the last presentation we did together that he's like the outdoorsman. Some of his interests are things like biking and just outdoors, but I always found this interesting was Frisbee. I'm like, grew up doing that kind of stuff myself, but I'm not that active anymore. And then I'm going to have Joanne kind of introduce the rest of the presenters today.
Thank you. I want to first of all give thanks to Bill Fakui with MedShark Digital. You've been in the dental marketing field for many years, and I've known you the better part of that, 20 plus years in specializing in internet marketing. Bill is the senior VP at MedShark Digital, and they develop super custom websites. They focus on SEO, Google Local Maps, pay-per-click, and social media. So for all of our attendees and future listeners, Bill will provide a comprehensive marketing audit and competitor analysis to you for listening to our presentation today.
Yeah, perfect.
And I'm sorry, you need to go back to one slide. We have our sponsors today from Bank of America. Forrest, would you like to tell us a little bit how Bank of America helps dentists with their practice acquisition or in their existing practice?
Yeah, definitely. Well, first off, thank you, Joanne, Brett, and David for having us on. So everybody listening, just make sure you take notes. This is going to be a very informative hour. So yeah, thank you again. And my name is Forrest Wiederman with Bank of America Practice Solutions. And as you can see on the screen here, I have a teammate. His name is CJ Williams. So Bank of America, who are we, right? We're the boutique division within Bank of America that only works with dentists. So in every single individual market, we have 45 of CJ and I, and we are delineated so specific that I only work on projects, which includes first-time practice owner startups, expansions, relocations, remodels, if you want to buy your building and relocate. That is what I do. And then CJ specializes on acquisitions. So if anybody has any questions, want to run any scenarios by us, here's our information, and thank you again.
Thank you, Forrest. So some of you are thinking about buying a practice. And if we could advance to the next slide, Bill. And you're wondering, where do I start? You know, the dentistry is becoming the easy part of my day. I want to have my own practice. Well, doctors, I want you to focus on, do you want to be in the downtown, maybe in the city? Or would you rather be practicing in the suburbs or rural? Because it's location, location, location. What type of facility do you want to have? Would you prefer to be in a professional building or maybe a nice retail center with plenty of parking and great visibility? When it comes to facility, yes, it's lease versus purchase. However, we need to look at what size of a practice. You might think, well, 3 ops, that's a lot for me. Doctors, 3 is not good enough. 4 is okay. 5, in my opinion, is ideal. Believe it or not, at some point in your career, you will have at least 2 rooms for hygiene, double hygiene. Yes, your hygiene department will be growing. So make sure you're getting a large enough facility. When you're looking for that perfect practice for you, we need to have you contact all of the brokers because they have their listings. So you need to talk to each and every one of them. Email me and I can give you the national list as well as the California list. Networking is critical. Sometimes you'll meet someone at the dental society. Maybe they're not selling. Maybe it's the specialist that knows of a colleague that's interested in selling. Oftentimes, I have clients that hire an associate that may lead to ownership in 3 to 5 years. But I want you to get creative. And I'll send you the sample letter because I had a client that we talked about this and he found a list of the dentist in the zip code that he wanted to purchase in. And he found a wonderful practice by taking time to send a nice letter about himself, his background, his philosophy, and his family. And yes, he found a wonderful practice. Then you'll want to create your team. So just like we have today, we know about the financial due diligence. We definitely need to have legal due diligence. What I provide is the management and clinical due diligence. Because doctors, when you buy a home, you wouldn't think about buying it without a third-party home inspection, right? And you're not going to get just anybody. You want to have somebody at arm's length and that truly understands the business of dentistry. So that's what we can help you with, the clinical and the management due diligence. So this is a wonderful graph that if the practice has Dentrix, EagleSoft, or Open Dental, we're able to calculate exactly how many active patients. Now, I realize that doesn't change the value. However, we like to know, are there 500 or 1,500 active patients, meaning they've been seen in the last 18 months. For example, in this chart, you'll see they have about 700 active patients. However, many patients are past due. Some have a future appointment. So not only will we help you understand what are you getting, I'm going to show you some of the pitfalls or profit leaks that you can fill and avoid to make it even better. We don't want you to pay for potential, but we want to be able to show you how to make it even better. So within the practice assessment, some people call it a chart audit. Doctor, this is not just a 1-hour meeting. And if you're right next to the seller, and I want the seller nearby, but we want to make sure we don't end up talking for 2 hours and only look at 3 or 4 charts. So it's not a chart audit, it's a complete practice assessment. We can occasionally help you with hands-on, or if you prefer, we can do a remote, because number one, we need to make sure you agree with the treatment philosophy. Because if the doctor is diagnosing a crown and you're looking at the x-rays and the intraoral photos and you're not understanding where they're getting their diagnosis, that could be a potential problem. One of the reports that we will show you how to generate is the pending treatment plan report. We call that the inventory, and it easily gives you a way to look through to get an idea of what type of cases. Are they small bread and butter crowns and restorations, Or are they doing a lot of crowns and veneers and full mouth? Because we need to make sure you can produce the type of treatment that they've been diagnosing. We're going to help you truly get behind the numbers. For example, we will study the procedure code report with you. This particular practice was indeed doing exams twice a year. We highly recommend that. But we also noticed that only 2% of the crowns needed a buildup. So sometimes there's an opportunity for coding properly and documenting, which will also add value of revenue to the practice. So you might say, wow, all these patients, they're not doing so much perio. That's a great opportunity, right, Joanne? Doctors, slow down when it comes to implementing perio right away. In fact, slow down on making too many changes in the beginning, because that hygienist brings a lot of goodwill, and we don't want to offend any of the team members or the former owner that they were doing things differently. So yes, it might be an opportunity, but that would come maybe 2+ years later after you have the relationship with the team as well as with the patients. So here in California and in many states all over the country, we have a situation with Delta. And whenever a doctor buys a practice or opens a second location, they will no longer be offered Premier. They must take the Delta PPO. So typically the seller will try and answer the question. And this is a true story that happened last year. My client told me, the seller told me 25% Delta. And of course, we've done hundreds of these and we know it's typically much higher than that. So I said, that's interesting. How did he do that calculation? He said, well, the practice, Joanne, I told you they collected about $1 million. And their Delta 1099, the reimbursements from Delta was $250,000. So that's 25%. But those of you, guess what? That's only the Delta portion. That does not count the patient copay. Therefore, Delta ends up being significantly more. And in this particular case, it was 47%. Most oftentimes I see about 50%. So it's 58% of the insured and 47% of all patients. Now remember, that's not a deal breaker. However, your banker like Forrest, your CPA like Brett, they're going to want to know, how are we going to make this work? Because that's going to affect your cash flow. And so the Delta is a very important part of that. And we can put together this PPO wizard for you. So when looking at the practice assessment, truly getting behind the numbers, how they're getting to the numbers are important. Now, although they won't be buying the accounts receivables, you are buying into a system that Dr. Seller has been allowing the patient to take 5, 6, or 8 months to pay off their dental treatment. And if you come in there because you have a dental student loan, you now have debt on the practice, and you can't afford, that's important for you to know what is the system that they had been offering. However, if you do end up buying the accounts receivables, and sometimes that's a great idea, if you can assure if it's been aged. What we mean, the Dentrix computer, the Open Dental EagleSoft, it gives us the aging, current, 0 to 30, 30 plus, 60 plus, or over 90. However, if the practice isn't closing out month end, so Joanne, what does that mean? Let's say the end of July, we don't close the month, but I do start posting August. I can get August numbers. I can obtain September numbers, but unless the seller is closing out each and every month, do you know that that accounts receivable does not age and you will be paying too much? You'll overpaying through the accounts receivable. Even if you're not working with me, we will do a complimentary screen share to be able to show you how you can justify and make sure the aging report is indeed accurate. Also, there's a liability. It's called accounts receivable credits. Through the years, the seller may have $50 here, $150 there. Patients might prepay, but sometimes we get more from the insurance company than we anticipated. This particular practice, there was 72,000 in accounts receivable credits. And as David, our attorney, knows, that's a liability that must be handled prior to closing. So again, if you're considering buying the AR, we'll help you determine, are they closing out the month end? Excellent. The last thing that we do for the practices is we create a SWOT, S-W-O-T, giving you an action plan. What are the strengths of the practice? Where are their weaknesses? Where are your opportunities? Maybe the seller has been referring out endo or some oral surgery that you can do. Maybe they're not offering any Invisalign and you're Invisalign certified. We can also look at some of the threats in the practice, and we put that in your comprehensive plan. Lastly, make sure that you have an IT inspection. The computer is an integral part because it could seem to be operating, but unless they're on Windows 10, some offices are still operating on Windows 7. They're not HIPAA compliant. And of course, you'll want to get your equipment inspected to make sure all the big ticket items are in good working order. And we can recommend some people to do that for you. Great. Next up is Brett, our CPA, to talk about the financial due diligence. Thank you.
Thank you so much, Joanne. Joanne and I have worked with so many buyers together through the due diligence process. She does such a great job in her analysis. If anything, she's going to give you confidence and a good action plan, to work through once you get into practice ownership. I'm with a firm, as Bill said, Thomas Stahl. We work exclusively with over 1,000 dentists and specialists. We offer an array of services from accounting to tax planning, practice transition consulting, wealth management, and retirement plans. And we are members of the Academy of Dental CPA. I wanted to give a shout out to our group there, which is a group of over 25 CPA firms throughout the nation, representing over 10,000 dentists. So I want to talk a little bit about the practice purchase timeline. A lot of buyers come to me and say, Brett, is this a good deal? Or Brett, should I buy this practice? I really encourage, let me go back a few slides. I really encourage you to narrow down the practice that you are looking at. Like Joanne said, location is key. Where do you want to be? What size of practice do you want to have? What are the profitability requirements that you don't want to go under, right? Really make sure that you're being vigilant about narrowing down and just looking at practices that are going to fit what you're looking for. It's not worth the time looking at every, practice and sending it to a CPA for an analysis. Once you've identified a few practices that fit you, it's important to do a comparison analysis and identify the practice that really is going to be the best fit. You'll submit a letter of intent, which in a lot of cases, you're going to work with an attorney to review the language in that letter of intent. And once that's submitted, you will have some timeframes identified for how long you will have on your due diligence, right? And when you're planning on closing and all the other key dates related to the deal. So I'm going to go back again to identifying the practice. The due diligence doesn't start until you've identified your practice and you've submitted the letter of intent. Again, it's super key for you as a buyer to identify the dentistry that's being performed. Make sure that you can handle everything that the seller's doing. Make sure that the treatment plan aligns, are the hygiene patients being pre-appointed and all that stuff that Joanne talked about. Once you've submitted the letter of intent, or when you submit the letter of intent, you are essentially going to offer a certain price to pay for the practice. And this is where a lot of people get hung up. And a lot of people, are looking for a deal. They're looking for a bargain. I personally have worked with so many people who've, almost hung up deals on the price that, it's more important for me as a CPA to just make sure that we are focusing more on the value that the practice will be giving you. You're essentially buying a machine that generates cash flow. And at the end of the day, my job as a CPA is to ensure that we have a very solid cash flow projection built for you, and that you know what you're getting into in terms of cash flow. We focus on the debt after, or the cash flow after debt service. And keep in mind, price is probably more important to the seller. I put a note on here that an incremental $10,000 increase in price corresponds to approximately $110 per month in loan payments on a standard practice loan. So yes, we want to do what we can to negotiate a good deal for you. But on the other hand, I think that the most important thing is that the practice is a good fit for you, and that the cash flow will work out for you going into this. So one thing that banks are concerned about is, can you maintain the production and collections? If you're going to buy a very large practice, we want to ensure that you can maintain the production being done. And so usually we have a discussion about that, review what your production is as an associate. Are you able to jump into the deal and be able to maintain the dentistry being done? We want to look at the overhead, right? Your overhead might not line up exactly with the seller's overhead. There may be some extra costs that you will incur as a buyer that you need to project out, right? Whether it be your insurances. There's a lot of sellers out there who aren't spending anything on marketing. You might need to put a budget for marketing efforts, right? If the seller hasn't done any marketing efforts, and you're going to need to build a website, and you want to get on social media, and you want to get some reviews built up online that are positive, you might need to spend some money. So what is that going to cost, and how does that fit into your overhead? We also want to know what your loan payments are going to be. And I really love Bank of America's options. They have lots of flexibility in their options, whether it be a 10-year loan or a 12-year loan, or even up to a 15-year loan. You can talk to Forrest and CJ about those options, but it gives you a lot of flexibility in terms of what your loan payment will be and how much cash flow you can generate by just moving your term on your loan around. So we want you to build out a projection, right, that shows the collections you're going to do, your lab and dental supplies, and all the other overhead, plus any new overhead that you're going to incur as a buyer. And then we want to subtract out the loan payments that you're going to have, and that will equal your cash flow after debt service. As a CPA, you'd think we're hesitant to take on loans, but when you're buying a practice, it's usually the opposite. My message is not to be afraid of taking on a larger loan. And I think most people will agree with this. I have two practices here side by side. One of the practice number 2 would be a loan of $755,000. Practice number 1 is a loan of $310,000. And you can see when we plug in the overhead of these practices, and then consider the loan payments, right? The larger loan is a $100,000 annual loan payment, while the smaller practice is only a $40,000 loan payment. But at the end of the day, the cash flow on the larger practice is, $120,000 higher, right? And so we don't get too concerned if a client is trying to buy a house and they have student loans, and then they're going to add on another large practice loan. Yeah, it's a lot of debt to take on, but at the end of the day, if you're able to cash flow higher from that larger loan, it totally makes sense. So going back to the practice purchase timeline, as you're going through your due diligence, Joanne talked about these 3 categories. She also does the management due diligence, which is very important. We usually kick things off with the financial due diligence because you don't want to get too far along if it's not going to make sense for you financially. You don't want to spend money doing the legal and the other clinical. Usually we'll start with the cash flow. And when I'm working with a buyer, I have a list of items that I typically request. A lot of these, if you're working with a reputable broker, they're going to include most of the items that we want to go through in the financial due diligence. But I've included a pretty comprehensive list for your starting point, especially if any of you buyers are on here that are looking at practices that don't have a broker involved, which happens sometimes. We want to get a seller's packet going, and these are the items that I usually start with. Number 7 might be something new to you. It says the 2021 General Ledger Report. What is that? That's simply the report from the accounting software that's being used by the practice, right? So it's your QuickBooks General Ledger. And that's going to show all of the detail going to every category in the profit and loss statement. I think it's very handy to go through that. That way, if you're looking at a practice and they say they're spending $20,000 in marketing, you might want to look and see, well, what are they spending that money on? Like, is this stuff that you really want to keep going? A lot of times I'll go through those and it's like, payments to a little league, team, or, just different stuff. You want to be able to analyze what are they spending money on in each category. Do you want to continue spending money on those items, or do you want to change your strategy going forward? The first thing I do once I've gathered all of that information in the packet is I will verify in the due diligence that the seller's prospectus or pro forma, they have different names for it, but that their adjusted net income is what I'm calculating. We want to tie back everything that the brokers are saying that they're doing as add backs. And so if you look up at the top here, there's a line that says income before adjustments. That's going to be your income on your tax return or the profit and loss statements. That's your starting point. And then we're going to add back all of the owner compensation categories or all of the owner benefits categories or anything else that they're spending money on that's an expense that you won't have to continue to pay after buying the practice. This gets us to a line that's called adjusted net income. And that's really what drives the value of the practices, right? Is the adjusted net income, the income before owner compensation. There are multiples that we use. In this example, I'm using a multiple of 1.6. It's down there. You can see these percentages, 160% and 210. Those are multiples that we are using on the adjusted net income of the practice. And those would give us the range of what we would expect the practice to be priced in. So what I'm seeing right now is the multiples. Usually practices are going for anywhere from 1.75 to 2.25 times the adjusted net income of the practice. Like I said, don't get too hung up on those multiples, because at the end of the day, if the practice is cash flowing and it works for you and it's in the right place, it may be worth overpaying. And that's what happened on this deal. This is a snapshot from one of the deals we analyzed, and they were asking $1 million. And the buyer ended up buying this practice, and it worked out great for them, even though our overall weighted price was $744. So yeah, the practice was over what we would typically see, but it still worked out. Once we've run the cash flow and we know that the practice will work for you, we'll also want to do the practice benchmarks. And this could be a really good tool. So I've got over on the right-hand side, industry averages. We typically want to group things into these main 6 categories. labor, dental supplies, labs, facility, marketing, and admin expenses. And you can see over there the industry averages, and you want to know if you're well above the industry averages or below. If you're outside of the range of the industry averages, we usually want to look into why and investigate that as part of the due diligence. A lot of times you will see that brokers will do add backs on their prospectus to normalize to industry averages. I don't agree with that. As part of your due diligence, you should verify that that's a legit thing. So one example is I had a buyer who was looking at a practice, and right on the prospectus it said dental supplies was 10% of collections, and the seller was adding back 4% of their collections to normalize to industry averages of 6%. And so I said, wait a second, let's look into this. And we pulled the general ledger report, and we're able to see all the detail that we're going into that supplies category. Sometimes equipment gets buried in the supplies category, and that's why you see these add backs. But in this particular deal, we didn't really see anything that stood out, and we determined that the seller had a very high supplies ratio, and so you want to know those things going into the deal, and not just assume all the add backs. By the way, for our clients at Thomas Stahl, we mainly work with people in the Bay Area and Sacramento area. And our average client is running at about a 35% profit margin. So an income before owner expense, that's the average profit margin for our clients over the last couple of years. So some of the other things you may want to request as part of your due diligence would be related to the KPIs, the key performance indicators. Joanne touched on some of these, but you really want to know, first and foremost, what the Delta Premier percentage is. How much of the practice is coming in from Delta Premier? Joanne talked about, how the 1099s aren't enough, but there are a lot of other tools. Joanne's got some great spreadsheets she uses where you can analyze these things. There's softwares that are available, that we can use to pull a true Delta Premier percentage. So just make sure you're utilizing the tools out there to really find what that is. You want to know what that number is going into practice ownership if you're buying a Delta Premier practice. Hygiene percentage is important. The percentage of total production that is from the hygiene department. Usually we want that at about 30% of the total production coming from the hygiene department. The hygiene ratio is hygiene charges divided by hygiene compensation. And so you're going to look at the hygiene production and just divide that by hygiene wages, hygiene payroll taxes, and any benefits going to the hygienist. That's going to give you your hygiene ratio. That number should be something like 2.5. So they need to be producing like 2.5 times what they're producing. The perio percentage, Joanne mentioned this. Again, it's something you may not want to push right into practice ownership, but a lot of practices being sold right now have low perio percentages. So, if you're doing these KPIs and you're finding, that the practice isn't hitting certain targets that you want to be at, you don't have to write off the practice. It could still be a great practice for you, but it's giving you a game plan on some of the things you can enhance. And if the cash flow is on the lower end of your acceptable scale, hopefully you can have a nice game plan to build the practice up and get it to where it needs to be. So open time, fillings per crowns, net new patients coming in are all KPIs that we want our buyers to look at. Just a couple other KPIs on the collections ratio. Practices should be collecting about 98% of the net production. And when you're looking at the accounts receivable, the amount over 60 days should be less than 10% of the total accounts receivable. That would show a very healthy accounts receivable and be an indicator that the office staff are very strong in their skills to be able to collect the money that's due to the practice for what's being done. If you're going to do any PPO reimbursement negotiation, this is going to be for those of you buyers who are buying a practice that's in network with a bunch of different PPO providers. If you're going to have a practice like that, you may want to negotiate your PPO reimbursements. And to be in the best place possible, you need to make sure that your UCR fee schedule is in the 70th percentile of the fee schedules in your zip code. There's different resources you can use to determine that, but usually the best starting point is looking at the top 10 CDT codes and what it shows on the UCR fee schedule, and just starting with that and looking there's different ways you can get the UCR fee schedules by zip code, but you want to know where you're at in terms of everybody else to be in a position to be able to negotiate those. We talked about profit margin a little bit. Our clients are about 35%, and you want to be buying a practice that has a solid profit margin. Once you get your due diligence done and you're locked in and you know that this is a good practice for you, you're going to keep moving the deal forward, and at some point you will get to an allocation of the purchase price. This is usually proposed by the sellers. Usually the sellers will propose an allocation, and all it means is that, you know, we need to allocate the purchase price to the different categories, right? Equipment, fixtures, and goodwill. Usually we see that the allocation will be about 25% to the supplies, equipment, and furniture and fixtures, and 75% to the intangible assets. At the end of the day, you're going to get to write off the entire purchase price. It's just a matter of timing on when you get to take the write-off. So I have a lot of buyers who have gotten hung up on this part of the deal. and I've even seen a couple deals fall through because the buyer wanted to, they wanted a certain allocation despite our efforts, right? And so, yeah, you want to negotiate a higher percentage to equipment if possible. That'll give you a faster write-off up front in the first 5 years and will help you with your cash flow. But keep in mind, the sellers have to pay more tax. They lose their long-term capital gains treatment. It's a preferential tax rate if they have to allocate more to equipment than they want. And so I wouldn't make this a deal breaker. Work with your CPA to try to get the best allocation as possible. But, you know, in many cases, sellers will lower the price, or they'll agree to a certain price with the condition that they get to allocate more to goodwill. And we see that pretty frequently. So just to recap the timeline, you're going to start your due diligence usually around 8 weeks prior to close. Sometimes it's longer than that, but if everything goes smoothly, that's about when that will help start. Your lenders, you'll need to notify them and keep them in the loop. And if you're going to work on any PPO negotiation, you would want to contact a PPO company and retain them about 8 weeks prior to closing, so they have enough time to work with you there. Once your due diligence is done, right, you need to finalize things with the lending. You're going to start the process on obtaining insurances for the loan. You're going to work with an attorney on the EIN, whether you're going to be a corp or a sole prop, that needs to be done. And then you need to review your marketing strategy and estimated costs associated to that. 4 weeks prior to close, you're going to be working on your lease stuff and signing the contract related to the lease. And just know that you have representation there, whether it's through your attorney or different players in this space that will work with you on lease negotiation. I get asked a lot if people should incorporate. That's a decision you need to analyze based on your income as a household. You, and if you're married, your spouse. We need to know what your income levels are. And we can let you know if it makes sense from a tax standpoint to incorporate. And so if you are questioning whether or not you should incorporate going into a deal, please have an analysis done, because there are some pretty substantial tax savings related to this QBI deduction that we need to look at for your personal situation. And there's my contact information there if you would like to reach out for questions.
Super, thanks, Brett. Our next presenter is David, and I'm going to let him run the show from here. David, it's all yours.
Thanks so much. First of all, I just want to thank everybody for having me here. I feel privileged to be among this group of professionals, and it's kind of amazing what you can learn in just, a short, 15 to 20 minute presentation. So I really thank Joanne and Brett for their really thorough presentations that sort of consolidated a huge amount of information in a small period of time. And one thing that I always love to do when I lecture is I love hearing other lecturers, because there's so much to learn from everybody, and I learn something every day. So again, much gratitude and appreciation. My name is David Cohen, and I own a law firm that specializes in helping dentists from a business law perspective. We did 330 practice transitions last year, and we'll probably be doing about the same, if not more, this year. So practice transitioning is something that we're really well versed in and have a lot of experience with. And so in the time of, all these practice transitions, one thing that we've come to learn is what are the most costly mistakes of practice purchases that get done. And today, what the presentation is about is the most 7 costly practice purchase mistakes. My contact information is here. I'm always very generous with my time and my team as well. So if you have any questions, feel free to call the number below or to shoot an email to my personal email address there. We're always happy to be a resource in the best way that we possibly can. So jumping right into it, number 7, and one thing that I will say is this really is a top 7 list. I think all of these are critically important, and this is not in order of importance. These are just the top 7 practice purchase mistakes that we see overall, all probably of equal importance. So number 7 is going to be the failure to implement an LOI exclusivity clause. And one thing that we're seeing with buyers is that it's happening more and more. It really did not used to happen very often, but we're seeing sellers pivot and entertain multiple offers at one time nowadays. And what's really critical when you're a buyer, when you negotiate your letter of intent, is to add an exclusivity clause through your attorney to that letter of intent that says that the seller has to exclusively deal with you from the time that that letter of intent is signed, and ideally up through the closing date, the proposed closing date. The seller may push back and want maybe a 30 or 60-day window or something like that. And that's negotiable. That's something that you'll lean on your attorney to help you negotiate. But the bottom line is you definitely have to have an exclusivity clause. The other key to this is that letters of intent are typically non-binding. And so there's really no point of putting an exclusivity clause into a letter of intent that's not binding, because usually the LOI is just a good faith understanding of the terms that everybody, once they progress the deal, sticks with. So on top of having the exclusivity clause, it's important to note in that LOI that the exclusivity clause is actually binding. If you state that it's binding, then it's binding. You can say, notwithstanding anything to the contrary in this agreement, this clause is binding, meaning that despite the fact that other things in this LOI are not binding, this part is, okay? That is huge because, you know, the common theme that you're going to see in this lecture is I'm trying to save you time, money, and headaches, okay? Three things: time, money, and headaches. And you're going to waste time, you're going to waste money, and you're going to have headaches if that seller goes and entertains other offers. You've spent money on legal fees and accounting fees, and you spent time and stress, and then next thing you know, they're pulling it and going and selling to somebody else. So please make sure you do that. In the most extreme case that I've seen, and this really has only happened once or twice in my career, is I've seen a seller actually negotiate another purchase agreement at the same time as my client's purchase agreement. And that was actually despite having an exclusivity clause. So that was another issue. But the point is, if you didn't have an exclusivity clause, you wouldn't have any recourse against the seller for doing that. So that's number 7. Moving on to number 6, it's the failure to address transition strategy with the seller. And what I mean by that more specifically is it's really important to be transparent and have an understanding with the selling party about what the plan is after the closing. Is the seller going to work for you for a period of time in the practice? Do you need that seller to work for you in the practice to make the deal work? Do you want the seller there at all? If you do not want the seller there at all, does the seller want to be there or need to be there? I think one of the biggest trip ups that I see in transitions is this issue doesn't get addressed till way too late in the game. You've got a seller who, for their financial plan, needs to be in that practice for, say, another year or two. You got a buyer who doesn't want them there. Or you've got a buyer who needs the seller because they're a huge part of the transition. And it's more than a one doctor practice, and they need that production for a period of time. And you've got a seller who's selling that wants to ride off into the sunset and doesn't want to work anymore. That's why they're selling. They don't want to perform clinical work anymore. So it's really important to get on the same page with that. Most of the time, we don't see it where a buyer has to have the seller there or a seller has to be there, but, and we see somewhere in between. And so usually it works out, but occasionally you will see this and it can become a very big problem. It honestly can be a reason why a transition does not occur. And again, in the process of saving time, money, and headaches, you want to get out in front of that way at the beginning so that you don't invest yourself into this whole negotiation of a contract. And then you learn, oh, wait a minute, I'm not on the same page with the seller. How could I ever buy this practice if this seller's walking away and moving to, Philadelphia the next day from the West Coast or whatever it may be? So make sure that you address this strategy with the seller from the beginning.
We need to go back.
We got froze a bit there and then skipped a couple. Sorry, I'm going to go back. Okay, number 5, it's the failure to negotiate fairly. My mantra is really that negotiation is not about winning and losing. Negotiation is not about taking more of the pie. Negotiation is about growing the pie and getting more of what you want without the other side being below the status quo. It's getting more of what you want without the other side being below the status quo. It's not a basketball game where it's a winner and a loser. You're not trying to beat the other side. In fact, the dental industry and the community is so small that it's in everybody's best interest to make a deal that works for everybody, okay? I don't necessarily love the win-win saying, although I think that's really what I'm getting at here. I think really the key is to make sure that it's a deal that's fair and reasonable for everybody, and that everybody's getting more of what they want without the other side being below the status quo. So the failure to negotiate fairly can often really tear apart a deal. Brett brought up a great example earlier of a deal falling apart because of a tax allocation and the buyer, not willing to go through with it because of something that they really would be able to write off anyway. They just might have to do it over a longer period of time. That usually should not be a deal breaker in a deal. And in my opinion, that is a failure to negotiate fairly, particularly because it means so much to the seller side under that circumstance. So how could the parties get more of what they want without the other side being below the status quo there? To me, that's a really easy solution where the buyer gives the seller what they want on the allocation because it means so much more to them. But then maybe the seller provides a concession in another way to the buyer that might be helpful for the buyer moving forward, something that maybe the buyer cares about a lot more, such as the non-compete parameters, right? Though that is growing the pie more and not just like taking more of the pie. So really key to negotiate fairly. Number 4 is the failure to implement and procure non-compete assignability. Really critical when you are buying a practice to make sure that there's language that says that non-compete that you have with the selling party can be assigned to a purchaser of your practice. Now, this will scare a lot of sellers because they're going to sit there and say, well, I'm selling to you because I believe in you to carry on my legacy. The last thing that I want is you flipping this to somebody else. And my non-compete's with you. I cut a deal with you, but it's not with somebody else. The problem with that is that it really just doesn't take into account a few things. The first is that while it's never typically the intent of a buyer to buy a practice and then flip it, it really, at the end of the day, the buyer paid the money and they get to make the decisions. But really, more importantly, there are situations that might be beyond the buyer's control that might warrant selling the practice, such as a disability, God forbid, or a death, God forbid. In those situations, that practice is not marketable anymore, or at least far less marketable if the party that deceased or disabled doctor is trying to sell to doesn't have a non-compete with the seller that sold to that party originally. It's just really critical that they know that they're buying something, capturing all the goodwill, and they have all the protections that were afforded to you when you bought the practice. So really make sure that you have that assignability clause, because it can restrict the marketability of your practice and possibly make it not marketable, because people don't want to pay fair market value for something that doesn't have the normal protections that every buyer typically gets. And a non-compete is not only something that the typical buyer gets, but it's probably one of the most important things in a deal that the buyer gets. So that's really critical as number 4. As we move on to number 3, it's the failure to procure adequate representations and warranties. What this means is, in a deal, every party is going to make promises to each other. The buyer is going to promise to the seller that they're capable of doing the deal and that they've done their due diligence and they understand what they're getting, among other things. And the seller has a lot more to warrant and promise to the buyer because they own the practice, and everything from the financials being true and accurate, the assets being free and clear of all liens and encumbrances. Those are just a couple of examples, but typically the seller has a lot to warrant, and it's important that the purchase agreement that you sign as a buyer has all of those protections. There should be a good 15, 20, 25 reps and warranties that a seller is making to a buyer about the practice. I just saw one the other day. We were representing a buyer and the seller furnished us reps and warranties, and there were about 3 on there. Now, understandable to some degree, the other attorney doesn't want to give too much away and wants the buyer to take the initiative to put those in. But ultimately, it's really important that the buyer does put those in, and they work closely with their legal counsel to make sure they're in the agreement. So again, things like making the seller promise the financials are true and accurate, making sure that the assets don't have any liens on them, making sure the taxes have been paid, there's no tax liens, making sure they've had adequate insurance on the practice. These are just several examples of what needs to be there, because most contracts will say that the seller is not promising anything about the practice other than what's in those reps and warranties. And so if you don't have enough of those reps and warranties, and there's a problem with the practice, as a buyer, you may not have recourse against the seller for that. And that can be a catastrophic mistake. So number 3, make sure you procure adequate reps and warranties from your seller. Number 2, failure to leverage professionals in your team. This is one of the first things that Joanne talked about today on her lecture. And it's just critical that you have a team. It's critical for 2 main reasons. Number 1, you may not have the requisite knowledge in whatever area that you need to in order to sell your practice or buy your practice or participate really in any way in your practice as you own it. Number 2, though, even if you did have all the requisite expertise and you were an all-star and you were a lawyer and a CPA and a dentist and everything, you probably would not have the requisite time to invest in it to do the proper job. So either way, it is critical that you have a team involved, because most of the time, this is the biggest transaction that you have ever entered into in your life, and maybe will ever enter into in your life. Most of my clients who are buyers have never entered into a bigger transaction in their entire life, and they may never do so. So why not hire the proper team, get the right professionals around you to make sure that you have a really smooth transition and that you're not making any mistakes, because you can do everything right 99% of the time, but that often is not good enough. You have to do it right 100% of the time when you're buying a practice, because the 1% could be your main pitfall that could cause you to set you back 5 years, for instance. One thing that I will say further about this is that, if you take the example of transition, that is when you're most vulnerable. I'll just put it like that. Transition is when we're the most vulnerable, right? If we're just sitting at home and if we're going on a trip in our life and we're sitting at home, most of the time we do everything that we're supposed to do and we have our thoughts together and we're organized. When you're on a trip and you're hopping on a plane and then you got to get another connection to another plane, and you've got a hotel that just got canceled and you've got all these moving parts, that's when you're going to make mistakes, when you're in transition. In sports, and you're in transition on a basketball court on a fast break, that's when turnovers happen. When you're in transition is when most mistakes are made. And so there's never been a more important time to have a team to not make mistakes when you're buying a practice. And then number one, and again, these are not in particular order of importance, it's just the top 7 mistakes that we see from buyers, is the failure to implement conditions to closing. Most contracts are signed in advance to close at a later point in time, mainly because the doctors want to know that they have a deal in place. If they're closing January 1 and everyone's agreed to the contract as of today, most of the time the doctors don't want to wait until January 1 to sign the contracts. They want to do that now so they know they have a deal. But it's important, if you're going to sign a contract in advance, that you have requisite contingencies in your agreement. Examples: if you're buying a practice where you're going to be leasing the premises, it's important to have a lease contingency. If you sign the contract today, but the landlord doesn't let you have the lease, or you can't negotiate a satisfactory lease, what good is it to you to buy a practice where you have nowhere to practice, right? So you want to have a lease contingency. Same with financing. Forrest would speak to that too. If you can't buy a practice if you don't have the money. So these are things that are just really important to talk to your attorney about, to have as conditions to closing if you're going to sign in advance to close later. Because again, what the condition says is, even though I'm signing now, if X, Y, and Z don't happen, if I don't get this loan or I can't enter into a lease, then I should be able to back out of this deal, because I don't want to be on the hook getting sued for non-performance. So that is the final thing that I will mention as far as the top 7 mistakes that we see in transitioning a practice. And again, this is my contact information. Feel free to reach out anytime with any questions. That's the phone number there and my personal email. And again, I just want to thank everyone for having me and giving me this opportunity. I feel honored to be amongst a group of great professionals, and also want to give a shout out to Bill for putting this together. I mean, this is just awesome, and he's doing this out of his own, generosity. So I appreciate that on my end.
You're more than welcome. And this was actually, I'm not in the business of dental transactions. I do dental marketing, which somebody mentioned earlier, but I will say there's never a time when I'm listening to Brett, and certainly you, David, really, really good stuff. And you talk in ways that it's not over, people can understand what you're saying. That even a lay person like me can really understand, the real important critical point. So good job.
Thank you.
We do have some, we're right at the top of the hour, but I still want to have an opportunity to address some questions. We've got some people, actually, we've got 2 people that already posted a chat about some questions. If there's anybody else that has questions that would like to ask it while we have these people on the line, now is the time to do it. But one of the questions that I did get, and it was when David was talking, was how many years and how many miles make a non-compete enforceable when, whether it's a purchase or sale.
Yeah, from that standpoint, it's really state specific. I think a lot of people have this idea in their head that there's a standard for the miles and the year period that a non-compete would be, but it really is based on the circumstance. And that lawyerly answer of it depends, that people hate hearing, it really does depend. It's based on the law in the state that you're in, and it's based on the circumstance. In most states, there's a reasonability test that says the parameters of the non-compete have to be the smallest that can legitimately protect that buyer without prejudice to the seller, right? Now, in a sale of a practice, it's really harder to prove prejudice because the seller just accepted a sum of money in exchange for their practice. And so there is going to be some sensitivity to the buyer in protecting what they just bought. Whereas if it's like an employment situation and you got an employee who just came out of dental school and needs to make a living, the state's going to have a lot more sensitivity to not wanting to place a restraint on trade. But from the standpoint of a non-compete, it's got to be reasonable. And that's that smallest that can protect the buyer without prejudicing the seller. In English, what that really means is it's got to be reasonable. So if you're in California and you're in the center of, Los Angeles, your non-compete mileage is probably going to be smaller than if you're in a rural area of California, because there's just, in a rural area, there's going to be much more territory where, for instance, patients come from, right? So that would be a factor that would be taken into account. So there's always sort of like a balancing test where that comes from, and the mileage is going to be based on that.
Oh, okay, very good answer. The next question was on Delta, and I don't know if it's best for Brett or Joanne to answer, but if a seller has Delta, what are your thoughts on going out of network, from the beginning?
I'll take that first. And as David said, it depends. It depends upon the demographics of the location. We had a number of dentists do this. One was in San Francisco, because you see, if the dentist is in network and then they leave, Delta sends out a very important letter to all of the patients, and they make it sound like you can no longer go to that practice. However, if the buyer never goes in network and explains to the patient, there's a change in our relationship, you will still come here. The only difference is that you'll receive the check. We have a far greater chance of success. However, if it's in a different type of demographic, that may not be an option. So call me when you're buying, and that may be a very, very good idea. Brett, anything to add to that?
Yeah, I'll add to it. I don't recommend going out of network first thing after practice acquisition. I mean, you want to maintain your patients. There are exceptions to that. So I had a client who went out of network. He was associating for the seller, and they went out of network together about 1.5 years prior to the transition. Worked out very well for them. They're about 2 years post transition right now, and their numbers are even better than they were prior. So the seller's still working back on that deal. I think he planned to work back for 3 years, large practice. So that's probably the exception to the rule. I have 2 other buyers who are intending to buy going into 2023, and they are going out of network with the sellers in the same type of structure. It's a pre-transition going out of network plan, and we're starting to see those be more and more common. But I don't recommend doing it right out of the gate on your own.
Hey, one last question, and this is, I guess it's more appropriate for Brett based on what his, but it's, should I incorporate if I'm going to purchase a practice?
Sure. Yeah. So I touched on this a little bit. You really need to look at your income as a household, right? So there are some tax savings related to to your profits. It's called the qualified business income deduction. And if your income is less than $200,000, if you're single, you may have some extra tax write-offs by being a sole proprietor. As a dentist, if your income exceeds that, then you're essentially not going to get that write-off anyway, and you may as well incorporate. In California, there are some new tax laws that were just passed last year that give you the ability to pay a portion of your state taxes through your corporation. And there are some other tax deductions available to people who have corporations. And so you really just have to analyze it based on how much income you have, did your spouse work, what tax deductions are on the line, and look at it from that standpoint. So that's from a tax standpoint. There's other, it's not just from a tax standpoint that we answer that question, it's also from a liability protection standpoint. But we would work with an attorney to make sure we're all on the same page on if it makes sense to incorporate or not for you.
Great. Last question that I got, and then again, we still have people out here that you want to ask a question. And I'm assuming it says, when should I hire an attorney to purchase a practice? I think maybe they were asking in terms of at what point do I need to hire an attorney, or at what stage of the process, I'm assuming?
Yeah, I'll answer that. Obviously, just being the attorney here, I think that it's never too early to reach out to an attorney to let them know what's going on, build the foundation, build the relationship, so that when it's time to go, you can hit the ground running. But I would say the most natural time to hire the attorney would be when you actually have paperwork to either draft or review in connection with the deal. So when you know you're going to go through and do a deal, or at least try to do a deal from a letter of intent perspective, that'd be when you hire the attorney to either draft that letter of intent or review it. And if you've already gotten past that letter of intent, it's kind of interesting, about 80% of our clients come to us having already signed their letter of intent, even though we ideally love to see it first. Then it would just be when it's time to review those contracts that come through to buy that practice, or draft if you're in a situation where you're drafting. In the dental industry, in most states and in most situations, the selling party drafts the documents and the buying party reviews. So it's just kind of a heads up on that. But I would say when you actually have things to review or draft would be the time.
Okay. Well, this is kind of a follow-up to that, because it came in right up. It's, how much can I expect to spend in advisors and legal fees in the purchase of a practice? So actually, all of you can kind of address that to some degree.
I'll answer it first, just because I was just talking, so that way I'll kind of just answer and then back out so that everyone else can jump in. But I would say from a legal fee perspective, it's definitely going to depend on the details of the deal, and it's going to depend on what I just talked about. Are we drafting or reviewing the contracts? There's typically more time and scope of work to drafting than reviewing. But we're going to look at the scope of work in terms of drafting or reviewing the contracts. Is there a real estate purchase involved, or is it just a lease? If it's a lease, is it an assignment of an existing lease or an entrance into a brand new lease? Are you going to incorporate? Did you talk to Brett and he said it's a good idea to incorporate? Those are all the things that we're going to need to know in order to assess the fee, just because the more of the scope of work, obviously, the more time involved and the fees are going to be higher. I can't speak for other law firms. I can only speak for mine, but we predominantly charge flat fees, so the client knows exactly what to expect. And I would say for a buyer, you should normally anticipate around $10,000 if you're going to buy a practice in legal fees. Certainly, it can be a little less or a little more depending on the details, but I think that's probably a good gauge to know.
I'll go next.
Yeah.
Great. So thank you, David, for clarifying that. And ours will depend upon the location, if we're going to go hands-on or if we're going to be offering a remote buyer assessment. Also a flat fee, because I never want you to worry that the next call is going to cost you additional money. So we cover phone and email support for 6 weeks, because I want to make sure it's a smooth transition. It would vary anywhere from $2,000 to $3,000 depending upon the level of service. And again, a flat fee.
So for CPA representation, the range is quite high. You're going to be anywhere from $1,000 to $6,000. My pricing's on the lower end of the range. You know, some CPAs that are doing $6,000 will, you know, they're going to be very, very hands-on. We typically will charge $1,250 as our base fee for buyer representation. That's going to be the cash flow. And then if you need to go deeper than that on your due diligence, such as getting into the Delta Premier analysis and things like that, we would charge extra just depending on what you need. A lot of cases we'll do the base cash flow analysis and tie out to the tax returns and that first level of financial due diligence. And then Joanne works with a lot of our buyers getting more into the detail on the profit leaks and different profit opportunities you have going into the practice.
Super. Well, I think we're done with questions. I want to thank all of you for investing your time and sharing your, and really the transparency. I was actually very impressed with the transparency in terms of, you know, your fees and stuff. A lot of times people don't want to, you know, tell what their fees are until they, you know, corner somebody. I appreciate your transparency and giving people the, you know, some idea of what all this costs in the process. So if there's any other questions, you can feel to reach them out to Joanne. Joanne is still going to be following up with people that may have some follow-up questions, but I appreciate everybody's time today. And we'll be putting a recording of this presentation online for you and others to share.
Thank you, everyone.